Welcome everyone, another Financial 15, and Kevin and I are kicking off another Becker Orr original series. We've done a couple in the past. This one's going to be all about saving tax in retirement, how to cut that tax bill in the retirement years, and we're starting off that series with CPP, specifically CPP sharing. You want to stick around.
Yes, one of the largest topics we ever get from anybody is how do you save tax more into retirement? And it's very important. There's a variety of different ways, and we want to go through those more of a step-by-step than just covering it in 15. So this original series is something that you should be watching. But to start off with, Clint, we are dealing with saving taxes in retirement in regard to CPP sharing. That's an important point. A lot of people don't know what it is. Let's start to explain this now, can we?
Yeah, absolutely. We'll get through it here, and to provide some context, we'll go through kind of the big barometer, the big buckets, if you will, in terms of how can you save tax in retirement, or really just in general. There's really three big buckets. You have your deduct, your divide, and you defer. The deduct is if you get a credit or a deduction, it can reduce the amount of tax you pay or your taxable income. The divide category, that's when you can split it between spouses, or maybe you divide it over a couple calendar years to spread out the tax burden. That's where CPP sharing falls in, that divide bucket. And the last bucket is defer, which is mean you just push the tax bill down the road. You don't pay it today, you pay it down the road so you can keep your money in your pocket, working for you longer, and push off that tax bill. So keep that in mind. We're going to go through a couple of videos here on this series, and they're going to fall into these different buckets. But today, CPP sharing, it falls into that divide category there, Kevin. And we should start right off the bat here. When should people even consider sharing their CPP? What's the optimum here?
Yeah, I mean, to consider it is going to be a variety of different options here. I mean, how long did people work on both sides of that coin? One spouse worked a lot, the other one didn't. What are they getting when they come to CPP? Those are a lot of the things that need to be considered. And there is a way to share this that's going forward, something that people want to take a look at. So we want to share income splitting between the spouses. That's the biggest thing to consider here. It is a between spouse thing only. We're not dealing with between you and a child or whatever the case may be. And it is most effective, as we've mentioned, when one tax is in a higher spouse, or is in a higher, should I say, higher tax bracket and receives a larger CPP benefit, whereas the other spouse is in a lower tax bracket and has a smaller benefit. That is the most optimum time to maximize what this is. Because again, if both spouses have worked most of their life, they both have roughly the same CPP, CPP sharing is going to do very little in reducing that tax that you're going to pay going forward. It's more effective when one is higher and one is lower. Those are sort of the big aspects as to when. But there's more to CPP sharing than just this, isn't there?
Yeah, we'll go through the details here, but that's the first one. If you're in the same tax bracket or have the same amount of CPP as your spouse, well, CPP sharing won't make much of a difference. It's really when there's a gap, that's when you can start to take advantage of that gap and help reduce the tax bill. So we know when it's effective. Let's get into how it works. And this is not income splitting. We should be quite clear. Income splitting is a whole different tool. It works a little differently. You have more control over it. Your accountant can do it at tax time. Not the case with CPP sharing. There's a formula involved. It's not necessarily a 50-50 split. The formula is going to be based on a couple of key factors. The factors will be how long you've lived together with your common law partner or your spouse, and your joint contributory periods. You have some jargon there. We'll explain some of the details there. First off, that joint contributory period, what is it? Well, if you have two spouses, that joint contributory period will start when the older spouse turns 18. You start contributing to CPP when you're 18, assuming you're working. So that would be the start of that period when the older spouse turns 18. And then when you're both collecting CPP, that period ends. So you can see it's a long period. That's the joint contributory period. And then how much are you eligible to split? Well, quite simply, how long have you been together with your spouse? If you've been married and living together for an extended period of time, they look at that time period, compare it to that joint contributory period, and that's the percentage that's allowed to be split. So that's how the formula works. We'll go through an example here so that can really kind of hit home and you can see the details, but that's the upfront jargon that we need to know. Let's put pen to paper here, Kevin. Give folks an example of how they can save tax with CPP sharing.
Yeah, exactly. By knowing what the parameters are, now we can at least give an example to show you how this is really going to work and why it's not income splitting, as we mentioned, in that traditional sense. So if we start with Bob and Joan, they're married. They've been married and living together for 30 years. Now, both will start their CPP at 65. And in this example, Bob's getting $400 a month, whereas Joan's getting $1,200. Now, if we assume Joan's 3 years older than Bob, so when Bob's 65, Joan is 68. Now, again, remember, if we're looking at a contributory period, as we mentioned before, it's when the oldest hits 18 and it's when the last one starts collecting at 65. So as we can see in this example, joint contributory period is 50 years, because if Joan started at 18, Bob at that point in time would be 15. So, and they will start the ending of this example when Bob is 65 and Joan is 68. So that's where we're going to figure out our formula, right? Is going to be that 50 years worth of scenario and sort of that 30 years they've been married. So that's sort of the first part of what we want to deal with on how we're setting up the parameters for this example.
Yeah, and those are key elements there. Understanding the joint contributory period, and then understanding that it's the time you've been together with your spouse that determines the percentage you're allowed to split. So let's get into the details here. So what is eligible to be split? Really, it's the difference in CPP. In this example, Joan's getting $1,200 a month, Bob's getting $400. So the difference between the two is $800. That's really what's eligible to be split. And how much of that will be split is based on that formula. 30 years they've been together, 50-year joint contributory period. So 60% of that difference can be split. So on an example, you had 800, the difference in the CPPs, 60% can be shared or split. You end up with about $480 that is eligible to be split. So take a second here to pause in the calculation. At this point, Joan now has 720 of CPP every month. Bob's still at 400, and we have that 480 that's now eligible to be split. So Joan's has gone down, Bob's has stayed the same, and we have a 480 that can be split. And the sharing here, CPP sharing, it is a two-way street. We can't just move that 480 all to Bob. It has to be divided. So you end up with 240 each to Joan and to Bob. And you can see the numbers there at the bottom of the screen as the final tally. You ended up with Joan at 960 and Bob at 640. So Joan's income has come down a bit in terms of her CPP, and Bob has gone up a little bit. So we've tried to level the brackets there, leveled up the tax burden. So a little bit of detail there, Kevin. Did you want to add anything to our example?
No, I think the only thing that we really want to make sure that everybody knows is that what we're dealing with here in CPP sharing is the difference between the two. It's not like an income splitting thing where you can take both sort of and almost combined and then split evenly. It has to be the difference between the two that you're dealing with. So all we're dealing with is that $800. It's not like we add it to $1,600 and then figure out a splitting. It is important to remember that CPP sharing is the difference. That's about the only point I'd add at this side.
Yeah, and the last bit here is just running some numbers. You can see in our example, remember our example, a joint contributory period of 50 years, and the longer the couple's been together, and that's what the column here on the left is all about, the larger percentage they're allowed to share. So if they've been together 10 years, well, 10 out of 50 is only 20%. They can't share quite as much. You can see the resulting CPPs. And the longer they've been together, the more they can share, and you end up with a more even CPP. Now, being together 50 years in our example, while Bob was 15 and Joan was 18, that's probably not a realistic number.
No.
But you can see the idea. The longer you've been together, the larger portion of that joint contributory period, more of it you can share, the closer you'll get to getting an exact even CPP, which means an even split. It helps level out the tax burden. So that's kind of the details there. There's a few quick items we have to mention here, Kevin. I'll throw this one to you. I think it's key because you already talked about this is not income splitting. It works a little differently, and this is kind of putting the cherry on the sundae in terms of how this is different from income splitting.
Yeah, I mean, basically what we're looking at here is the actual cash payment is changing. So going forward, it's no longer that, okay, you're going to get $1,200 and Joan or Bob is going to wind up with $400. Going forward, based on our example, Bob is going to get an actual cash payment at $640 and it'll be indexed going forward. And Joan's actual payment is going to be $960 indexed going forward. And that's how this is split. It's not like we can wait longer and get a better sort of percentage going forward because they've been living together longer. Remember, it's when one starts, it's when one hit, or the last one hit 65, and that's where our actual cash payment designation is going to go. So that's important to remember, that it's not one that we can change each and every year. Once it's set, this is the way it's going to be going forward.
Yeah, and that is true. And also, when we're talking about pension income splitting, that's what an accountant can do at the end of the year. So cash flow doesn't actually have to change. The payments can be the same. At the end of the year, the accountant has some freedom to make some changes. Not the case here. The cash actually gets divided, as you mentioned.
Yes.
And it's not automatic. You have to apply for this. They don't just automatically start sharing the CPP between spouses. You have the government website there, canada.ca. You can see the form, the ISP 1002. And like you said, once you hit that button, it's going to stay that way until one of a couple of items happen here, Kevin. You can see them there. It's, you read them out. How does this end?
basically the only way that this ends is either A, you wind up divorced, and then there's a situation that goes on there. B, a spouse dies, or the couple can actually cancel this going forward if they don't see it. But again, like we did to get it, you have to apply. If you want to cancel it, you have to fill out a form to say, look, we don't need this anymore. There's other options we're dealing with, or there's other ways we can income split along those lines. So that's basically the only 3 ways that it can go away. And I would probably rather do the last one than the first one, because it's probably going to be less costly in the long run. But again, that's an important point to know, is that these are the aspects of CPP sharing that most people don't realize, and the way that it has to be done. So Clint, what else can we add on the CPP sharing to end this?
I think we covered it well there. A good point to keep in mind is that the difference in CPPs is the key item. If both you and your spouse are getting similar amounts of CPP sharing won't be that beneficial. If there is a larger difference in the CPPs, well, then this is something to consider, because you could get some tax savings and reduce those tax bills in retirement. And of course, any other questions, any other topics you want us to tackle, you can find us, get a hold of us, chatwithclintonkevin.com. You can fill in the form there. We'd love to hear from you. Any question, whether it's on finance or you want to pick Kevin's brain on the Jets or any other topic, we're happy to help out. I'll throw it to you, Kevin. You can get the final word today.
Yeah, so this is the original series. Remember, this is going to be the first of a number of them. So CPP sharing is just the start of it. Make sure that you tune in for the rest of them as we're going to go forward, because there's a variety of different ways to save tax in retirement. We want to make sure we're helping you get the best method that you can, so that you have to pay the government less, keep more in your pocket. Other than that, I think the first topic's been covered. We will come back with another one very soon. And I think we're done for today.
Take care.